When it comes to raising capital, deals can be scut from lots of pitch cycles, legal routes, and endless calls, just for the possibility of being funded. At the same time, a huge number of potential investors are locked out of deals that could shape their future portfolios. So innovation stalls, capital sits idle, and too many great ideas are left on the table. That's why we built VentureCrowd, to connect the world of entrepreneurs and investors and do both sides of get a deal. We're Australia's most ambitious digital investment platform, powered by our own proprietary Agentic AI, making it faster and simpler to raise capital. And with all of double the raises set to launch in the next 12 months, we're entering our most scalable phase of the business yet. Right now, you can become a shareholder and off us, set the future of the private markets. That's me. As a former corporate lawyer and PwC partner, I help close hundreds of deals, and I can tell you, the private capital system is broken. It's slow, unclear, and built for insiders, and we work to change that. But we're not just another platform. We support equity, debt, and hybrid raises for venture capital, property development, and private credit deals, as well as syndicates and managed funds. At the center of our technology platform is Kai, our purpose-built AI. It helps founders launch faster, raise smarter, and stay compliant. It guides investors to the right deals at the right time, and it empowers our teams with intelligence and data-driven decisions that improve efficiency, reduce churn, and unlock more capital raise. This is custom AI built by us, and it is the future of digital capital raising. But here's the bigger picture. Today, VentureCrowd has 79,000 registered members, $440 million raised across hundreds of projects, with $30 million distributed to investors since we started. And now we're accelerating everything we have, using 10 years of campaign data, platform activity, and investor behavior to help us scale smarter, faster, and further with our proprietary proven AI. Since launching our Agentic AI platform, our revenue has grown by over 30%, and the founders using our platform 200%. Now we're raising capital to fast-track our psychology build with new tools for founders, deeper predictive insights, and expanded automation, allowing us to scale globally. We've built the infrastructure, the marketing ready, and this is your chance to be part of what's next. So let's unlock the next wave of innovation together.
Well, welcome everybody. Thank you for your patience and the change of room. It's always a good problem to have when there's too many people for the previous venue and you've got to shift it to a larger room. We've got a lot to cover tonight, and it's going to be a pretty action-packed series of content. But before we do that, I want you to imagine that it is 1993 and you're standing on the floor of the New York Stock Exchange, and a small group of innovative financial technologists ring the bell that morning for the first time. And what they're launching is relatively unremarkable. It's just a fund, quietly named the State Street S&P 500 ETF. And in that moment, what feels innocuous and unremarkable changes the investment markets forever, because that was the first exchange-traded fund in the world. And for the first time, ordinary investors could get access to the performance of the entire stock market in one click, efficiently, transparently, and at a fraction of the cost. That world first ETF fundamentally changed the way the investment markets work. That small piece of innovation reshaped the way the investment markets would operate all over the world. From that point onwards, for the next decade, the ETF market grew tenfold, trillions of dollars poured into ETFs. Access, which was previously reserved for institutions, now became mainstream. And most importantly, it was all being done off the back of innovative technology. So that moment equally was a moment that shifted the investment markets in a way that we had not seen up until that point. And now we are standing on the precipice of a similar point in time. The only difference is, this time it's bigger. Because this time, we're not talking about the public markets at all. We're talking about the private markets, the fastest growing segment of the investment landscape, where arguably the most exciting, the most interesting companies are being built. And this time, the access to innovation, the barriers to innovation is significantly lower than it used to be. With advances in technology, including AI, which we'll get to later on, allowing us to do things like due diligence and access to deal flow that wouldn't be previously available to you, to the operation of a campaign, through to screening your investors, through to investor management in a way that's never been possible before. So the next transition, the next analogy to what happened with ETFs is happening in the shift between the public and the private markets. And 12 months from now, everything we're about to talk about tonight will be old news. But tonight, you're hearing it at a point where we believe the door to the transition of the investment markets from public to private and the opportunities that come with that are just occurring now. And so there is an opportunity for everybody in this room, whether you're an investor or an advisor, to see space for yourselves and for your business and for your portfolio in what we're about to discuss today. Now, personally, from our business's perspective, we're very clear about what that opportunity is. And we're very clear about the role that VentureCrowd will play in the transition from public to private markets. But this event is not for us, it's for you. And so what we've done tonight is we have curated a discussion which we hope will be of value and of help to you as you consider the opportunities for yourself in the shift to private markets. And we're going to do that through the lens of a number of subject matter experts. Right at the end, I will wrap it up, and then I'm going to invite you to stay, have another drink, and meet some of the wonderful people that are in this room and continue the conversation in a more social sort of format. So hopefully that's why you've come, and hopefully the content will be of value to you. But let's start here. If you unpack the data on the investment markets for the last decade, one thing becomes very, very clear, and that is that the investment markets are undergoing a massive shift from public to private. The public markets at the moment, the listed markets at the moment, are declining at the fastest rate in 25 years, according to JP Morgan. And that shift, that decline, is expected to continue into the near future. As a result, as more companies stay private for longer, arguably the best performing company, the most interesting and the most innovative companies stay private for longer, the public markets no longer give you appropriate diversified exposure to the true universe of corporate stocks. If you want that, you have to invest in private. And that's exactly what is happening. Investors across the spectrum, from retail through to the top end of town, are redirecting capital to the private markets en masse, looking for greater diversification, higher returns, and more direct ESG outcomes. And for that reason, the private markets over the last 2 decades have continued to grow spectacularly, and they're forecast to continue to grow even more spectacularly over the next decade, with these forecasts suggesting 21 trillion by 2030. I think that's outdated. That's 2024 numbers. I think it's going to be significantly greater than that. And so, when you compare these two charts against each other, the movement in the public markets versus the movement in the private markets, I don't think it could be clearer where the investment markets are going next. Public markets in decline, private markets on the incline. The only way to get diversification into your portfolios is to have a strategy around private assets. So, as the investment markets undergo this massive global shift, not just in Australia but all over the world, from public to private, millions of new investors are demanding access, mainstream access, in the way ETFs previously provided, to all sorts of private assets: venture capital, property development, private credit, managed funds, no longer reserved for institutions in the top end of town. Mainstream investors are now pushing for this kind of access. But the question is, how will they get it? A quick look at the size of the market tells us this. According to ANU research, the Australian National University, there are 3.25 million eligible wholesale investors in Australia as at 2021, I'm sorry. This is 2021 figures. They're the most recent figures that we can point to that are validated by independent research. Obviously, in the 3 years that have passed, with at least property prices increasing, that number is significantly higher today than it was back in 2021. But let's use the number that I can point to somebody else doing the research on to validate. 3.25 million wholesale investors in Australia at that point. Of that group, 690,000 odd are considered high net worth individuals. That is, people with investable assets of more than $1 million. Those people typically have access to alternatives. They typically already have access to private assets, and those assets are already in their portfolios through their brokers, through their advisors, through top end of town access. The other cohort to consider in the 3.25 million is SMSF trustees. There's 1.2 million members managing over 1 trillion Aussie dollars in the self-managed super fund sector in Australia. Now, that group of people, it's very difficult to get accurate research on how much access they have. Our view, though, is that their access to alternatives, their access to privates is mixed, and their experience with privates is mixed. Hard to tell exactly how much. But then, even if you exclude those 1.2 million SMSF trustees, there's still 1.4 million eligible investors that sit in that group that are in the other category. They're eligible wholesale, but don't have institutional relationships, don't have minimum check sizes that get them in the door with most of the private assets that are available to the top end of town. And so the question becomes, as the shift from public to private continues, and as the mainstream demands private, curated, quality private assets, how will they get access? Now, we have a very clear view on that, and that is, in order to service that number of people with smaller check sizes in the way that they need to be serviced digitally, in the way they expect to be serviced by financial services technologies, translating that to the private markets means the only way to service that group will be through platform technology. And that is what we have been building for years. For this exact investor cohort, for this exact moment in the transition of investment markets from public to private. VentureCrowd is a digital investment platform for alternative assets, and we focus on 4 asset classes: venture capital, property development, private credit, and managed funds. And the point of it has always been, and is still today more than ever, to provide access to as many investors as possible, as seamlessly as possible, by providing that access digitally, by reducing minimum check sizes, and making the entire customer experience as seamless as possible. It should feel like you're ordering a pizza, but below the hood is where we hide the technical and regulatory complexities that are involved in the curation and origination and due diligence and management of private market assets, which everybody in this room knows is not as simple as ordering a pizza. We want to be a domain expert, but with the brand that gives and invites maximum access. Now, shortly you're going to hear from Adrian in relation to the managed fund side, and specifically in relation to Sydney Angel Sidecar Fund, and David in relation to the property side. But in relation to the venture capital side, just for a second, let me give you an indication of the kinds of companies I'm talking about. When we talk about the mainstream investors, let's say it's 1.2, let's say it's potentially 2.6 million people looking for private assets as they seek to diversify their portfolios in this new age of the move from public to private. What exactly does that mean? This is a company called Ingenic. Ingenic is a cancer therapeutic that rolled out of CSIRO. They came to us and raised $5 million within 5 weeks on the VentureCrowd platform. This company is on track to become $1 billion company from Australian innovation, but you can't buy Ingenic shares anymore because it's not listed. The only way you could have participated in a company like this would have been to invest early and to invest through platforms. This is 4D Medical, also raised money on the VentureCrowd website and exited by listing on the ASX 18 months later at a 295% return for our investors, which surely in anybody's book is an exceptional return. You can buy 4D Medical shares now because they're listed on the ASX, but you'll never get the value uplift that was available to you while that company was private. And thirdly, this is Morse Micro. Some of you might be familiar with this. They just recently raised an $88 million round and are now valued at $500 million. Morse Micro now has in it, as part of the most recent round, institutional investors at the top end of town, here and globally, as well as major family offices, including the Turnbulls. But when VentureCrowd investors invested in Morse Micro on the platform, it was valued at $40 million. That's a book value uplift at 12.5 times. You can't buy Morse Micro shares anymore. You had to invest while it was early and while it was private. So really, the only question is, who will be next? So our job is to originate, to curate quality investments across the 4 asset classes that I mentioned. And we believe that there is significant demand from a growing number of new investors who, for the first time, are looking to diversify their portfolios with private assets. And that is an opportunity for everybody in this room, whether you're an investor or you're an advisor.
Some people actually ask, what is angel investing? Because it's not as common as what people think. Really, it's an individual person who provides private capital to a business in exchange for convertible debt or equity. It's investing at the earliest stages. Got to stare it on the spot. It's investing at the earliest stages, and it's super high risk in nature. I want to talk a little bit about the evolution of angel investing over the years. It used to start with an individual person investing solo by themselves. They would generally write a check for $100,000 to $200,000. They would do a handful of these investments. Due to the high risk nature, it would generally fail. And when they'd say, this stuff doesn't work. It's not a great experience. We then evolved to angel groups, which was coming out of the GFC across Australia and a lot of other markets globally. Syndicates got together and groups of people said, well, actually, multiple minds can actually get a better decision as they're actually working through and doing investments. And they started investing together, which actually lowered the threshold for people to get involved in angel investing. But it still requires a significant amount of work and investment of time and resources and expertise to actually make those investment decisions. And it's quite hands-on and quite intensive. The market then evolved into angel syndicates. Slight variation to angel groups, whereas what people would do is back almost a single person doing the due diligence, doing the work. It's almost like a fund, but you're backing the single person. Often in a structured vehicle so that you could do a very, very small investment and get more diversified through that. But you still had to go and assess the person you were backing to do the work. You had to rely on the fact that that person was going to be around and be interested and stay involved in what was possibly going to be a 5 to 10 to 15 year investment period. And then we moved to where we are today, where what VentureCrowd is doing, which is democratizing venture capital. We're leveraging the power of the angel groups, which is multiple people being involved, and then we're letting people back those on a diversified basis on a more passive arrangement, not having to rely on a single person and therefore getting access to a group of people. The chart on my left, your right, shows you the growth of the ecosystem. This is a chart that Airtree put together, which is companies that are worth more than $100 million, starting by the decades of where they were. So the 90s, then 2000, 2010, and then 2020. And you can see a proliferation of companies because this ecosystem is growing and there's more and more money in the ecosystem. And as more money comes into the ecosystem, more startups grow, more expertise, and the whole thing feeds and becomes a bit of a virtual circle. So how does Sydney Angels actually work together? It's a group of 80 to 100 people who work together to actually co-invest in deals and actually do due diligence. Deals come through the year. We get 30 to 50 applications every single cycle. There's 6 cycles a year. The committee and the deal team review those. They filter those down to what they think are the 6 best possible deals. And then those 6 deals pitch to a deal screening meeting. We then filter those 6 deals to what they think are the 3 next best deals. Those 3 best deals then pitch to a full members meeting, and then a syndicate forms around those deals and actually does due diligence. And then out of all of that, 1 to 2 of the 3 will get invested in over a period of time. The group exists to try to help people. The group exists to help source better quality deals, make better decisions, and collaborate together, educate investors to become better investors, and take advantage of the networks that are there. So we're going to talk a little bit about the sidecar fund. The sidecar fund is what's called an early stage venture capital limited partnership. It's a terrible name, but it's one of the best things that exists for a fund in Australia, because you get a really, really rare thing, which is you get tax-free returns. And it's not often that the government lets you make a return and pay no tax. And in fact, it goes one step better, that when you make the investment, they even give you a 10% rebate on the money that you actually put in to actually encourage it. It's a $10 million fund with a maximum ability to go to $20 million. I talked about tax-free. It's co-investment. So it's got the exclusive arrangement with Sydney Angels, such that every single deal that passes through Sydney Angels that has DD done on those companies, those members then back up their DD with their money. They put their money where their mouth is. And so long as 3 of those members actually invest, the fund will actually co-invest alongside as an appropriate DD process has been done. It's targeting to get 25 to 35 companies. So it'll be the companies that have come through the process and any company that's been through Sydney Angels. We're going to target an investment, an IRR rate of return of about 20% per annum. Important to note, the follow-on investments are actually the discretion of the committee. Key thing we want to announce is that we've done the first tranche and we've done the close, and Sydney Angels has actually invested in its first company, which is a company called iShield. See some details in there. It sounds a little bit corny, but they invented something called the kidney pajama. And it's a little medical device that actually goes around the kidney as it actually goes through a transplant. And it keeps it at optimal temperature during that surgery. It's low cost, it's really, really high margin. It's targeting the US market where there's 30,000 transplants per year. So that's worth about $150 million worth of revenue potential per annum just for that US market. They've got a granted patent in Japan and going through PCT phases in other markets. And they've got a clinical trial underway. The other one that you can see is a range of logos there of other companies that have been recent investee companies that are high growth, high potential, and are likely to be raising further funds in the future, of which the sidecar fund will have a co-investment opportunity in there. So you've got some other biotech type companies, software companies, AI companies. There's a whole lot of fantastic companies in there. What does that mean?
The major inside the heart of Winter.
As lead investors and partner Transetti Sunaco and allowing us to not only raise your funds, but also in allowing us to exceed our divergence and variable awareness of who we are and what we not do.
So that was Jeremy from iShield. You can find out some more information on the QR code. We'll be around to talk a little bit later, and I'll pass it on. Thank you.
Good evening and welcome to today's property presentation section of the Capital Markets Showcase. I'm going to talk about property's place within a portfolio allocation, concentrating on the development stack because that's primarily what we do, using some real world examples that VentureCrowd has in the market currently. Property, of course, offers a broad spectrum of risk-adjusted returns, from passive income generation to more active investments in the equity and secured debt layers of property development projects. These opportunities, of course, have been generally gated, often requiring personal or other institutional relationships, often sourced through brokers, sometimes through pool funds, often with large commissions and high minimum invested amounts. Property investment can offer solid portfolio diversification, and residential development returns are driven in large part by the performance of particular locations. And as you will see, we're very strong on the southeast Queensland property story. That particular market has seen some of the best capital growth probably anywhere in the world. Private direct property investment through VentureCrowd can and has generated returns in the range of 10 to 40%, depending on the project level of risk versus security. It's an attractive option for investors seeking higher growth returns as part of a mix. We've returned up to 40% for some of the equity tranches that we've given in some of our projects. Pref equity we've generally targeted between about 12 and 18%. The lower ones on these generally represent timing in a lower interest rate environment. At the MES second mortgage stage, between 12 and 20%, and I'll talk a little bit more about one of those products coming up. And first mortgage stage, generally between about 9 and 12%. The property team that we have at VC is comprised of experienced development managers with about 100 years of experience between us. That doesn't mean we've got a heap of people. It means we've got a lot of experience with quite a small team, actually. So. We've got a number of live projects underway currently. We have different offer windows that do open and close depending on the project funding requirements. The second mortgage we have at Cumulus Carrara, which is open now. I'll concentrate on soon. I'll talk about that. A particularly interesting one we've got at the moment is equity in Morningside, top right, and also Moorferry Road. Morningside co-living is a particularly interesting opportunity. It offers exposure to development and the ability for ownership as well. Its returns when it's operating will be about 6.75% net, growing to almost 8% by year 5. And that is net on a residential opportunity. Please do find me after the showcase if this one interests you, because that's something that requires a bit more conversation. Some of the closed opportunities examples include equity and pref at our 46 townhouse development in Albany Creek. Offers are closed and we're repatriating about $11 million of principal and interest, actually beginning effectively tomorrow, next month. And we've got equity and debt products on Glenvale, which is our 324 lot residential development in Toowoomba. It's about 50% sold. It's closed for investment currently because the first mortgage and the equity already invested will take us to the end of that project. Equity and P&I is progressively paid down at each stage settlement. You'll see from these projects that our investment thesis has been laser focused on the southeast Queensland, and particularly the project I'm going to talk about now, which is Cumulus at Carrara. It's on the Gold Coast, and Michael Matusik, who's one of the foremost property economists, identified 7 core criteria underpinning an upcycle. The Gold Coast had every single one of those, namely population growth, employment growth, rising wages, undervalued housing, a supply shortage, a balanced demographic mix and lifestyle appeal. Many of you will have seen that Gold Coast average apartment values recently overtook Sydney. Coupled as well particularly is the dire undersupply of land in the Gold Coast region. Resale house listings are sitting at only 4 months supply, apartments and townhouses even worse at 3.6 months. So the project I'm going to focus on now is Cumulus at Carrara, where we're open for investment in a second mortgage product, offering 20% per annum with redemption of the facility, targeted to commence the third quarter of next year. Cumulus comprises 59 luxury houses in a gated community on a ridge overlooking the broad beach skyline. The beach, Pac Fair Shopping Centre and numerous golf courses are only about 10 minutes away. Cumulus includes a common rec facility with tables, barbecues and a 20-metre long infinity pool. The entirety of our site is over 27 hectares, of which only 3 hectares is developed. The remainder contains walking tracks in that native vegetation, allowing residents to exercise and walk the dog. Civils are complete. Our experienced builder DevCon is on site piling and slabbing with framing imminent, and completion of that first stage of 23 plus the rec centre, as I said, is scheduled for the third quarter of next year. And that's when redemptions of that second mortgage are targeted to commence. We're offering a mix of luxury 3 and 4 bed houses, with some of the 4s having 2 master bedrooms, 1 up, 1 down, allowing for separated disability or intergenerational living. Most importantly, the prices range between about 1.5 million for the 3 beds to just over 2 million for the 4s. That's about 7,200 per square metre, or about half of a new non-beachfront apartment on the Gold Coast. So in other words, for the same price as an off-the-plan non-beachfront apartment, you'll get about double the house area, you'll get an extra car, you'll get all that bushland. On the funding side, the equity for this project was closed oversubscribed some time ago in just a few weeks. And our first mortgage is in place with a group called JVL, the Van Lieshout Group, some of you may know, and it's in place until the end of the project. We're not required to make pre-sales as a condition of the funding. Nevertheless, to ensure we commence payout of the second mortgage facility on settlements of the first stage next year, we've commenced sales with contracts, with a number of contracts in place already. We only need a very modest sales rate of under 2 sales a month to sell this stage out. In the project, it's, as is always the case, VentureCrowd's profits at risk first, then unit holders further up the risk curve in equity before the second mortgage. Gross profit on current revenues post-debt is forecast to just over $15 million. Pretty well all major costs, including the build contract especially, are all now locked in, and we will keenly look to drive revenue increases during construction, like we always do. At Glenvale, the large project you saw top left at Toowoomba, we were able to push those prices about 30% in 18 months. And at Albany Creek, the townhouse development on the bottom left, we raised prices by over 16% or $150,000 for a 3-bed townhouse in about a year. If we were able to do that across the project at Cumulus, that would be another $8 million in revenue. As stated, the equity and first are placed. The second mortgage fund is the final opportunity for investors to have exposure to the project. After repayment of the facility, the first mortgage and equity are forecast to cover project costs for future stages. As I said, the fund offering 20% per annum is open for investment. If you'd like more information on the project or the fund, you can use the QR code that you can see on the banners back there or here to register your interest. One of our team will be in touch, or you can, of course, register privately through the VentureCrowd website inquiry. So thank you. That is a little case study on how we do property in the private markets.
Well, hello everyone. Thanks for joining us. We're almost at the end of the evening, 2/3 through maybe. My name's Rebekah Blake. I'm the head of compliance and investor relations here at VentureCrowd. And also, I forgot the clicker. I knew there were too many things. Oh, Dave, I've gone the wrong way. This is us. So my team looks after investors post-financial close. And in my view, yes, you've got the piece at the beginning, but actually that's where the real relationship begins. So our job is somewhat complex, but I like to try and make it simple. We want to make sure every investor knows where their money is, how it's performing, and what is the next step. Now, as part of my role, I also lead the compliance committee. None of this we can do without an AFSL, so it's a really important part of our business, essential. I review compliance plans, manage the KYC and AML, liaise directly with ASIC, and ensure every part of our multi-AFSL business runs to best practice standards. So it's certainly not the flashy front end that you see here tonight, but it's what keeps everything running smoothly, transparently, and of course also compliantly. And for me, I love an empty inbox because that means that our investors are really getting the clarity that they need from our regular communications that we send out to all of our investors in every fund. Now, excuse me, in that particular vein, I would like to introduce James. So obviously, this is not James's real name and not his photo, but he's very much a VentureCrowd investor, and this is his actual story. So we essentially are James's private market strategy. Now, James joined VentureCrowd in January 2022. A month after that, he invested in the preference equity of a property development project in southeast Queensland. That returned 12% per annum, 12.5% per annum, which was paid monthly in arrears. It's pretty simple. Then in March, he invested into the equity that Dave just showed before of a property project in Carrara on the Gold Coast before the boom. So the forecasts hopefully saying that he will do well there. In April 2022, he dipped his toe into venture capital for the very first time, which is what's really interesting about this multi-asset platform. And he invested in an Australian medical device company called Neopharma. Now, having an interest in health himself, he then invested into the VentureCrowd Health Tech Fund. So that was also a first for James in investing in an actual ventures fund. He then took a stake in Nexpa, so that's a consumer goods company with kombucha that you probably see on the shelves of Coles and Woolworths. And then in February 2023, which was his sixth investment, he invested in a first mortgage fund providing construction finance for a residential subdivision that you saw before in Glenvale. So today, James holds 13 investments with VentureCrowd that total 2.2 million and has seen returns of over 883,000, including an IPO. So in short for James, VentureCrowd is his private markets portfolio strategy. Now, we think that that's the power of a multi-asset platform approach, which is diversified, he's kept informed, and it's, of course, compliant. And James is a great example of how that strategy for private markets works. Now, for me, over the years, I've spoken with hundreds of investors, and the clear trend is emerging, like Jack was showing before. Wholesale investors are increasingly allocating to private markets, and often they're actually doing so without consulting their advisors first. So I know there were some advisors here in the room. But advisors, I think, are really crucial to this shift. Now, the opportunity, I think, for advisors that are in the room here is to keep your clients close by giving them the private market strategy, giving them the curated, compliant and high quality deal flow that you know you can trust for them. And that allows you, the advisor, to provide oversight and, of course, strategic guidance that they need for their portfolios. But alternatively, if you are a wholesale investor that's confident about building your own strategy, like many of you here tonight, and of course like James, then VentureCrowd or any other trusted platform that gives access to private markets should of course be key in your overall investment strategy. Now for VentureCrowd, we think we bridge the platform between those private markets and professional advice, giving investors the access that they do want and the assurance I think that they need. Thank you.
And now the moment you've all been waiting for. But thank you, everyone. That was excellent. I think that was a good foundation for how we'll end the conversation tonight. And first of all, thank you for your time tonight. Head of AI at Optus. You can't have a lot of idle time in your day, so really appreciate your time. tonight we're going to have a little bit of a real conversation about Agentic AI. There's a lot of hype, there's a lot of speculation, there's a lot of talk about what is AI. And in the context of private capital markets, that's even a deeper conversation, right? So we'll take you through sort of the chats that we normally have, Jesse and I. And maybe let's start with the first question. I just came back from San Francisco. We were invited to the largest tech conference in the world, Salesforce Dreamforce, mainly because we were some of the pioneers in building Agentic AI solutions in the Salesforce ecosystem. And what I tell my team is, I feel like I came from the future. The conversation is really advanced there. There are many steps ahead, and it feels to me like they've gone past the might we implement AI? How do we implement it? Should we consider implementing Agentic AI? Feels like the conversation has already passed those steps, and it's now more how do we do it in a way that's trusted, that's reliable, that's repeatable. Where do you think Australia is in that curve of innovation and adoption?
Perfect. Well, thanks, Diego. Thanks all for your time this evening. I think what is fascinating about the Australian market when it comes to AI is that we're actually seeing this huge shift, which is to say that it felt like a year ago, the conversations were about, is this thing real? Is this just the next big tech trend that is going to disappoint us? And I think what we've seen over the last 12 months is a real explosion in not only new businesses emerging that are building their products and their platforms with artificial intelligence at the core, but also large enterprises beginning to use it and to understand the value and the implications of AI to the products and services that they offer. And so at least what I see is that we're actually at this point to say everybody's now extracting value from the technology, and the questions are beginning to shift to not about should we do this, but how can we do this faster and how can we do this safer? And so I think we're at this inflection point where we're going to see this huge shift in focus towards acceleration using AI, which I think poses many opportunities in the Australian economy, but also then poses many risks and challenges around the implications of the technology to our economy and to our workforces.
Yeah, that's right. And that's sort of what I saw in the future. I noticed that, it's all about speed now. It's all about how fast can you move, how the velocity that you can keep in innovation. And we've been deploying Agentic AI solutions for 3 years now, before Agentic was a buzzword. And early on, we realized, and what I've noticed over the past few years is you either focus on automation or you focus on augmentation, or you focus on a mix of both, right? So humans with AI in collaboration. Where do you see that taking shift in the private capital markets, and where do you think companies should focus on?
It feels like at the moment there's, I think, a lot of dreams around like pure agentic AI, being able to automate process and workflows end to end. However, I don't think we're there yet. And I think really where we're at with AI is that it's a tool to really enable, to empower, and to supercharge people in our teams and in our workforces. And so when you think about the ability for it to help being somebody in marketing, being able to develop content or collateral, to go find the right audiences for content, jobs and tasks that may have taken days, weeks, months, in some cases years for large organizations, can be done in seconds and minutes using the technology. And so I don't think it's a case of letting the technology do it itself completely, because I don't think we're quite there yet. However, it's how do you help supercharge the people inside our businesses, inside our workforces, to get more done using the technology.
Supercharge is a word they use a few times, and I could go in many directions here, but specifically in private capital markets, how do you think Agentic AI and AI will supercharge specifically private capital markets?
So I guess my view on this, it sits in a couple of different layers. I think first is that for investors, they can make the process of investing simpler, easier, and faster. the ability for you to now conduct research, find new investment opportunities, and then to be able to understand the implications of that on your portfolio, forecast the future implications, can be done in, again, seconds of units. Jobs that may have taken weeks, months of efforts, or the best efforts of teams of advisors supporting you can now be done instantly. Even while I was watching Steve's opening and looking at some of the figures on high net wealth individuals of Australia, wrote a prompt, had ChatGPT 5, the deep reasoning agent, review 172 sources of economic data that exists in Australia, international research on high net wealth individual market movements, the value at stake, and came back and validated all of Steve's figures. So kudos, Steve. But it's an example of that, of having a team of experts being able to connect to data in real time, sitting in everybody's eye. And so I kind of go for the investor. The game changes instantly, which is to go, a lot of the information asymmetry that we may have had in the past disappears. But then for, I think, people in the shoes of being at the issuer, all of a sudden the ability for you to access private capital and to diversify your access to private capital actually again becomes simpler, easier, and faster. Like your ability to now set up campaigns, be able to engage investors, and to engage them in truly personalized ways, not just big blasts or knowing people and kind of giving the nudge on the deal, but actually being able to use digital channels to do this at scale opens up so many opportunities to make the whole ecosystem, again, better, faster, safer. And I think that's the big opportunity, is that when we connect both those things, unlocks so much growth in the economy, but also then huge opportunity for issuers and investors at the same time.
Unlock is the other keyword they use a lot. And I feel like Agentic AI is unlocking full potential of humans, of economies, of companies. Private capital markets have always been about human relationships, as you know, and who you know and who you talk to, and the human aspect of it. How do you think the embedding of agentic systems and AI systems in private capital markets will evolve to keep some of that humanity and, but taking it to the next level?
It feels like it'll do one or two things. I think for many relationships that exist, actually strengthens. And I think, again, it comes down to that ability for the machines to be able to help you with analyzing vast amounts of data, being able to help you assess opportunities. And so instead of us sizing each other up or we're meeting each other, all of a sudden you have access to fact, knowledge, data, intelligence. That means that the relationship that you have, like many of us are forming in the room tonight, become even more important. Simultaneously, though, I think there's a new class investor that is emerging, particularly in the Australian economy, that are digital native. They are being brought up using these tools and these services as part of their everyday life. And so you think about that in the context of the private capital markets, it's materially different to the way that they've operated in the past. And so the ability to have them have access to the private capital markets through digital platforms that are always online, always available 24/7, the ability for them to do it from the comfort of their home, their bed, or wherever they are on holidays, the ability for them to not speak to a human in the end-to-end journey also becomes possible with platforms like VentureCrowd, but this shift as well. So I think it'll do two things. I think it'll strengthen relationships and in some ways make us more human with each other, but then inversely also take the humans out of the loop and open up more opportunity at the same time, depending on, again, your experience and your preferences too.
Spot on. I think it helps us, spend less time on toil and more time on the things that add value and the things that you're really good at. Now, I'm really conscious that I am the last person holding you back from a glass of wine. And I've actually never had a 10-minute conversation with Jesse, ever. Normally, we would lock a room for 4 hours and talk away. So I'm really holding back. But as a builder, we always like to compare the innovations that we build. What is the most exciting thing that you feel we're working on at VentureCrowd right now, in terms of AI and Agentic AI that you're excited to see what comes next out of it?
So one of the things that actually hooked me, we first were discussing the roadmap, the technology, and looking at the architecture that Rebekah brought up just briefly before, was actually this, it's quite a simple idea, but it's brilliant. And that is a marketing campaign agent. And having worked in very large enterprises, inside Optus now for a year, before that, the Commonwealth Bank for a decade, leading all their emerging tech and innovation, looking at these big processes like marketing and seeing all of the different handoffs, all of the different people that exist in that value chain, mean that this will sound odd to anybody that hasn't worked in enterprise, but simple things like drafting an email and sending it to a group of customers could take 16 weeks.
Compliance,
the data team, the data team trying to figure out the audience, scheduling it with the comms team, like getting brand to review, compliance, legal. There are so many different stakeholders in that value chain. And getting to see the way that you had thought about campaign execution using Agentic AI to say, well, what if you were to, in effect, parallelize the process, so have all of these steps run by agents all at once, and then kick out to a human when it's needed, so for compliance review, but fundamentally have AI help with drafting the communications, developing the asset, doing the data analysis to find out who has the propensity to invest and why, personalizing the communications to them, kicking it out for review by legal, and then pushing the big green button. I kind of looked at that and went, through 16 weeks of work in enterprise that I watched get done in under 2 minutes. Incredible. Actually blew my mind. So when you think about that in the context of the platform, when I looked at the issuer journey, which is fundamentally about executing campaigns, the velocity of the capability of putting that in the hands of an issuer on the platform is incredible. And I think that such a core foundational process that you've made literally many times better. So that to me is like real world example of AI being used to help make something better, faster, safer. In terms of like the future roadmap, looking at things like how we start to expose AI to help with issuers setting up campaigns and helping them with positioning, particularly in the venture space. Super interesting, using all of the intelligence of many years worth of deals and transactions to help figure out what works best. Incredible. But then again, also just even some of the core machine learning work around figuring out if it's the modeling from the entire audience base and investor base and trying to figure out what do people want and why, connecting them to that, I think will help create more journeys like James or Fake James through the platform again and again and again. So very excited, very proud to be a part of the team.
Thanks, Jesse. And it's been an absolute pleasure working with you, and getting your advice, your feedback. It's been super valuable. I think I just want to end with one note. For us, when we talk about Agentic AI in the context of private capital markets, it's not just deploying AI for the sake of AI because it's trending. I genuinely believe that it will be the greatest advancement that we can have in unlocking private capital markets and providing access at scale. Technology has been and will continue to be the greatest enabler in that kind of progress and access. And what we're seeing with AI is something that we've never seen before, and it will accelerate things dramatically. And for us at VentureCrowd right now, it is giving us speed in product development that we've never had before. So we're really excited about what's next. Thank you for joining us tonight, and I will hand over to Steve. Thanks, Jesse. Appreciate it.
All right, let's wrap this up. I hope that's been helpful so far. let me just close out by summarising, if you don't mind. I think it's difficult to dispute the fact that the investment markets, the global investment markets, are moving from public to private, and that this is one of the greatest shifts in the investment market in a very, very, very long time. And that just like the introduction of ETFs and what happened to the investment market after ETFs, this is a moment where those that see it early will build generational wealth. 12 months from now, this will be an old story. Today, you're at the beginning of something that we think is very, very exciting. Millions of new mainstream investors will be looking for ways to access private market assets in venture capital, in property development, in private credit, in managed funds. And they will need a way to do that is seamless, that is digital, that is fast, that is what they come to expect from the way services are delivered in any other part of the market, right? Why should the investment markets be any different? And why should the private markets be any different? The answer is they should not. So what's about to happen over the next 12 months is going to address that issue, service that need, and create a brand new way of operating in the investment markets that doesn't exist today. And that's what we are super, super excited about. That is the role we want to play in this process. You've seen this before. The way we do that is to continue to hone and perfect a AI-powered digital investment platform for alternative assets focused on venture capital, property development, private credit, and managed funds. And to do that with the specific purpose of making those kinds of deals available to as many people as possible, as seamlessly as possible, with the lowest possible entry price. To do it at scale, essentially. And so far, it's working, right? We did $8.1 million worth of revenue last year. That was 33% up from the year before. 4,500 wholesale registered members, 4,500 wholesale certified investors, 80,000 registered members who have collectively invested with us over $440 million. We've returned over $42 million since we started. One of my favorite stats about the business is that our investors' average ticket size is actually $45,000. We have a 57% repeat investment rate. We're really proud of that because that tells us we're doing something right for people to be investing that amount of money and to come back over and over again. Like James, he is not a unique example, and we're really proud of being that solution for that new and emerging group of people. And we've talked about some of the returns. So, you know, there is something really beautiful about democratizing private assets. I came from a relatively modest family as a kid. We didn't have a lot. So the idea of being able to bring to the mainstream the ability to earn the kinds of returns that private assets allow you to generate and to remove those barriers is a very, very exciting personal mission for me. If you'd like to get under the hood and become a shareholder with myself and Sean over there and a number of extraordinary shareholders that we already have, we will be opening a convertible note round next week. You can scan the QR code for more information, go onto the website, in the booklet that you've got, or stick around and have a chat, ask us all the hard questions. But we invite you to participate and to help us shape the future of the private markets. This is going to be a very, very exciting 12 months. If this resonates for you at all, we invite you to join the team. Thank you so much for coming in. I hope it's been useful. Yeah, thanks. I appreciate it. Not necessary, but thank you. Just before we sort of wrap up the presentation, it was pointed out to me that people may have questions. We won't take a lot more of your time, but I did want to offer just the opportunity to ask anything that might be on your mind. Maybe we take another 10 minutes to do that, and then we can have a chat privately if you would prefer. But does anybody have any questions that they want to ask in this forum now? So I'm sure you've got the chance to do that.
Thanks, Steve. That was great. Sorry. How do you think about liquidity of the assets on the platform in all four categories?
It's a really, really good question. The easiest one to answer is in the property space, where property development projects ultimately lead to the sale of dwellings, and the revenue from that ends up capitalising the fund, which allows you to distribute capital back to the market. Simple there. Private credit, same thing. Loans have a term. Ultimately, they're repaid, and you get liquidity that way. Managed funds a little bit different. Obviously, venture capital funds have a longer run and depend on liquidity in their portfolio. But in venture capital, which is where I think your question was actually going, it's a really interesting one, right? Because if the public markets are in decline, the opportunity for liquidity for the companies that you invest in then obviously limits too. And so what must happen over the next 12 months in the private markets, in our view, is liquidity mechanisms that are private market specific. So if you look at our roadmap, which isn't here, but it's in the IM, I'll be happy to send it to you. At the end of 2026, we are earmarking secondary trading as a key part of what we must build for exactly that reason, right? You can't say to people, the private assets can do all of these wonderful things, but you can't get out ever, right? Or unless there's a merger or whatever. There has to be a liquidity mechanism prior to a major exit event, and we're very much aware of that. We have a view about how we might build secondary trading into the platform, but we haven't formalised that view, so I prefer not to say any more. But it's absolutely on our radar. It will be, if you like, the final piece of the puzzle in the delivery of the tech waiver. Are there any other questions?
How do you see the increased regulation from ASIC affecting the private market returns?
Yeah, it's a really good question. We've been spending a lot of time with ASIC recently because they want to understand every single aspect of our business. When I make a statement publicly like, we want to make private assets available to as many people as possible for as low as possible ticket price, ASIC freaks out, right? But then, there are 3.25 million wholesale investors. That market alone is, available to us to offer appropriately curated, appropriate level of quality private assets. So the statement remains, right? I'll give you an example. When I was a member of management committee of Sydney Angels, I was a partner at PwC at the time. And what I'd get asked every single time a deal would come through is, aren't there like 500 partners at PwC? Why don't you just put it to all the partners? And my answer was always the same, and that is, I am sure they would love to participate in this deal, but you would need to make it super simple for them. You would have to be digital, you have to drop the investment price, and you have to provide them with all the information that they need. Do that, and I guarantee you'll syndicate capital from a whole lot of people who otherwise would not have participated in the market. And so when I think about the regulator, I think it's a matter of we'll just continue to engage and be as helpful as we can in explaining the model. Now, from a retail perspective, we do have we have two Australian financial services licenses, retail and wholesale, and in both of those licenses we have authorisations to provide a broad range of different financial products, including operating as a crowdsourced funding intermediary. So we do have the ability to offer to retail investors equity in venture capital products using the crowdsourced funding regime, and we do. So it's not disingenuous to say we are genuinely trying to provide access to as many people as possible, depending on if it's appropriate for retail or if it's not. Is there anything else burning for anybody else? All right, cool. Well, thank you so much for joining us. Please don't go anywhere. This is a room full of amazing people. If you haven't had a chance to mingle and meet, grab yourselves a drink, take advantage of the opportunity while you've got them all in the one room. Thanks again, and enjoy the rest of the night.